Hello and welcome to Options Guy TV. Easy for me to say. My name is Brian Overby. I am the author of the Options Playbook. And every time I try to talk too loud this morning, my voice is going to crack a little bit. So with that said, we have an exciting day in that we did a couple of trades in FedEx. And it's kind of weird. There might be a situation where one trade was very bearish and one trade was kind of bearish. And the market actually opened up and made that trade profitable, the skip strike butterfly that we looked at on Wednesday. And then it reversed and the market is now flat and it's actually gone down a little bit in FedEx. So I want to spend a lot of time today just looking at the two trades that we put together on Wednesday, the two paper trades around FedEx earnings. They announced last night after the close and made a very strong move to the upside. That they maintained that move on the open, and then the market has reversed at this point in time. FedEx in general, the numbers haven't been great, but they did better than anticipated. And also there was a little bit of a dead cat bounce situation, I think, going on where going into the earnings report, FedEx, all the numbers and all the forecasts were pretty bad overall. One second. And then ultimately we got a big bounce after the reported earnings. So the terminology, the old terminology, is even a dead cat will bounce if you drop it from a roof. So the numbers have not been good in FedEx, and and after the earnings report, there was enough positivity to make the stock make a decent jump to the upside. So here we are. Stock right now is at $277.50. It's up $2. Overall, we saw the market make a big move to the upside overnight, and it continued that move on the open. The stock was up about $10 on the open, hung there for a few minutes, and then it started coming back down. So we will look at the first trade that we put on. We used the December 20 option contracts, and we sold the 320 strike call. And actually, I don't even need to put it together because it's so obvious that this went out worthless. We pulled this entire trade together. We got a real decent net credit to the account. When we put this trade on, we received a net credit of 45 cents. Okay, so we were well beyond a one standard deviation move. And on the skip strike butterfly, I'll just show you the trade in general. What we were doing is we bought the 320. We sold the 327.50, this one. And that was a sell, not a buy. 327.50. Oh, that's why, because I don't even have a bid on it. And then we went out and bought the 342.50 on that one. So this is a 1x2x1 butterfly. It's obviously trading for nothing. We put it on for 75 cents or for 45 cents. And we had the potential on the open that the market could have landed somewhere within the 320 to 327 range. Market after hours was at around $3. The expected move was about $29 on the underlying. It moved $20 overnight, and then it only opened up 10. So no big deal. There was a small chance that the stock could have worked its way up towards the 320 level and landed somewhere in the middle. I personally did this trade in my own account, and on the open, my strikes that I had, because I set it up on Thursday, I had the 305 strike call. So on the open, I was actually able to put this trade on for a net credit and actually take the trade off for a net credit, a decent net credit, because the market was anticipating that it was going to open right around 300. Market, my butterfly was at 305. I closed it on the open for $1.20 net credit to the account. 55 cent net credit to put it on, $1.20 net credit to take it off. That is right. I said that correctly. 45 cent net credit to put on and a $1.20 net credit to take it off. So we put it on and off for a net credit into the account. And this is a 1 second. Back. Here we go. So this is a weird trade that allows you to do that. Now, we have a different trade on. And we paid a little bit more for this trade. This was the bearish aspect. And I didn't like this trade as much going into the actual earnings, mainly because, once again, I was a little bit nervous in that the market was so negative. If we pull up the chart on FedEx, let's look at it real quick. And I'm just going to zoom over here. But the look at the movement just through the day. But the market was so negative coming into earnings. How many? There's only what? 1, 2, 3, 4. We got 4 up days, and these are dojis, which are usually the sign of change, and then back down going into the earnings. And then obviously this is the earnings, the day after earnings. So the market was so weak going into it that it was hard to continue to be weak going into the be bearish going into the actual earnings report. But I did set up a different trade. Said that if you were looking to do this trade, let's remove this one. Actually, I'll send it to the one if calculator just in case we come back and talk about it. And this is one contract. And then we went the opposite direction here. So let's close this out. And we go down, and the strikes that we looked at on the downside is we did a modified butterfly. They're still trading for not much, 270, but it's still within play. Okay, so our trade on the downside, if we were going to get more bearish, was to buy the 260, sell 2 of the 245s. And then buy the 235s. Excuse me. Okay. Now, this is trading for nothing at this point in time. We needed the market to come down to the 260 level and trade between the 260 and the 245 level. The market opened way up. It came back down. Now, this position, in my mind, is having a chip in a chair. The market is still weak in FedEx. The numbers still were not amazing. If the market did pick up momentum to the downside, because it definitely opened up and now it came back down, this one still has a smidgen of a chance, right? It's a lottery ticket at this point in time. I wouldn't close it out. If this is the way that you want with the trade, I wouldn't close it out. We'll just let it ride until the expiration. But right now, things don't look good on this trade. You paid for the trade. We paid, let me look at it real quick, like $2.40 for the trade to put that trade on initially. $2.40 or $240. Now, I chose the skip strike butterfly because the more I thought about it, I was a little bit worried about getting a little bit of a bounce, like the exact opposite of what you usually say, where you are selling the rumors and then buying the news. So In other words, the people were getting short the market going into the earnings report, anticipating that it was going to be bad. And then once it actually came out, we got a little bit of a push to the upside. So kind of reverse in that. A lot of people say buy the rumor, sell the news. But in this instance, it was sell the rumor and buy the news. And that actually is what happened in FedEx. Okay, so now I can't talk loud. Now, if the market is finally having a solid day, it's been very, very sketchy ever since the Fed meeting, and a little bit nervous. There's a little bit of nervousness about the sticky inflation numbers and what's going on with that, and the fact that the Fed is more than likely not going to cut as much or as quickly as anticipated. And the market really took that hard. And the biggest thing that I see here is the VIX index. And I'm highlighting the VIX index on my screen at 1894. It's down $5 on the day. We had a big move up on that trade. I want to actually get short the VIX index. I'm going to do a VIX spread over the weekend. So if we go and we look at and we pull up the VIX, this is going to be my official paper trade for the day. We're going into the January expiration, which is the only expiration that I really like to trade is the actual normal expiration on the VIX. So we got to go out to January in order to trade those options, and that is 22 days away. We got the VIX up a little bit higher, so I'm going to put this trade on, and this trade's going to live for a few days. And this goes into the inauguration and the changing of the guard, everything that's involved. So to start with, I just want to get a little bit negative using these VIX options with this expiration date. So January 22nd is the expiration that we're looking at. Right now, if we just look at the call options and the put options, we see that the futures contract is trading right around where the 19 level is, very close to here, somewhere between 19 and 1950. You're paying $252 for the call on the 19 strike, and then you're paying $270 for the call, or $235, and then it goes to $270 on the 1950 call. So the actual futures contract is very close to this level. So I want to straddle that level. And I want to say that I think the market will go down heading into the new year, and it will trade somewhere below the 17 handle. So with the market at 19, I'm going, well, let's go. Let's buy the 20 strike here. And we're going to, do we think it gets below 17? Or do you want to say 1650 or 1750? 1750, you're getting quite a bit of juice just going up 15 cents on that. To say that we're going to get bearish that way. Yeah, let's sell the 1750. All right. So in this instance, we are going to, I don't like to do the half point strikes. I don't know why. I just think it's old school for me. We're going to buy the 20 strike call option with the January 22nd expiration. And we're going to sell the put option, 1750 put option. We're going to do this for a net debit to the account of $1.64. So a speculative trade saying going into the end of the year, you expect volatility to decrease. And at some point in time, you expect this futures contract to be down. You're hoping that it gets down to the 15 level, 16 level, something in there. We're putting this on for $1.64. The difference between the strikes is $2.50. So the maximum it could trade for is $2.50 if we put this trade on. Let's send this to the what if calculator. And let's scroll out a little bit on this. Oops. It's the calculator's not really grabbing that one corner of it. But here's where the market is at. We want the market to come down from the 19 level and go somewhere around here. If we get down to that level, the maximum we can make on that trade is $87 by that expiration date. And yeah, that's the way. That's going to be the paper trade for this week. So I'm going to take a screen grab of this. We're going to be watching this trade, and if the market does come down going into January, going into the expiration, I don't mind actually coming back and getting long the VIX. I'm going to trade some VIX option contracts going into the inauguration on Friday, the 17th of January in 2024. I expected a pullback. We had too much euphoria in the marketplace. I just didn't expect it this soon. And so I'm a little bit sad because I already missed out on the VIX trade to the upside, which I was kind of hoping that the VIX was going to stick around the 13, 14 level going into the new year. And I mentioned that a few times on the show, but we got to move quicker than anticipated. And the fact that the markets were at all-time highs and a little bit more elevated, the swings, I think, when you got that euphoria in the marketplace and all of a sudden you get some bit of bad news, the swings to the downside can be a little bit more aggressive. And that's what we had here. I mean, we had a big jump up in the VIX up to about the 25 level before it started backing off. I was looking at this trade on Wednesday and Thursday, but unfortunately, the market has now came down a little bit, and we're seeing the VIX trading around that. Well, now it's all the way down to the 19 level or beyond. In other words, I wanted to do this trade for Options Guide TV on Wednesday, but we're here. I don't mind it. I do anticipate that going into the new year, with the holidays, everything that's going on, we will drift lower still in the VIX. The VIX wants to trade around the 15 level. That's where the 200-day moving average is at. So this is going to be the official paper trade. And I persevered, was able to soldier on. I have a little bit of a cold, don't feel bad, but the voice isn't hanging out too well. If you have any questions, let me try to address them. And if not, we're going to be back Monday. We're going to do a Monday show for Options Guide TV, and then we're going to run into the holidays. And I'm going to have a nice educational piece that I'm going to put together between Christmas and New Year. That's going to be the top 5 mistakes that option traders make. And so please tune in for that event. This trade, I'm really not going to do much with it. If the market goes up, I'm going to ignore that. We have a lot of time on our VIX trade. We're not going to really look at it again until we get to the middle of the month in January, maybe the 10th, maybe the 11th, somewhere at that point in time, and see where the VIX is at. And then we'll manage the trade accordingly. Thanks for stopping in. Have a very happy holiday. Well, I guess I'm not quite there yet because we are going to have a show on Monday morning, and we will put a trade together for the holidays. We'll come up with something that will be more of a neutral trade, and it'll be based on an index. So thanks for coming in, and we'll see you this Monday at 11 a.m. Eastern time.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.